Given the current market meltdown globally, a lot of gold investors are left wondering this week, why did the metal not rally more so and has not hit its original highs of 1900 or more? Joining me today to talk about this and hopefully shed some light is Dan Oliver. He is a partner over at Myrmikan Capital. He joins me on the line. Dan, we're so used to seeing each other in person, but given the current environment, thank you for joining us via audio today.
Sure, happy to be here. I guess wherever here is.
We're both in New York City,
Exactly.
but exactly. But keeping ourselves germ-free and virus-free here. Dan, why isn't gold higher?
Yeah, so I think it's got to do with margin calls, right? I mean, if you remember what happened in 2008, gold should have gone higher, did go higher, but it had to go a lot lower first. Gold went down $300 from 1,000 to 700. Oil went down 80%. So the gold oil ratio went crazy, which is fantastic for gold mining. And that's actually when I got into the trade at that moment, when I saw that divergence where nominal prices had collapsed, but real values had gone through the roof. We certainly are not anything like that for lots of reasons. One is gold in that bubble had gone up nominally with the market. It went from 250 to 1,000. So there were lots of fast money traders levered up in the gold trade. When they got margin calls and redemptions, they had to sell, and down gold went. If anything, managed money has been short gold in these last 10 years. Everything else melted up. So we don't have the same kind of cross margin call activity. But of course, there's some, and especially in the junior mining space where I am, it doesn't take a lot of retail selling to really push prices down. But if you look over just any kind of intermediate term, you see gold is way, way up from where it's been. Oil is way, way down, especially after this war within OPEC plus with Saudi Arabia and Russia at each other's throats. That is fantastic for the economics of gold mining. If you're a gold miner, one of your major input costs are energy, and that just went down. Your diesel prices just went down. I mean, not overnight. It takes time to get through the supply chain, but they're going down a lot. And meanwhile, gold is going up. So that is fantastic. We're not having the nominal drawdown in gold prices that we saw last time. So my expectation is that the whole world is waiting on the policy response. If they don't respond, the whole banking system, the whole economy is going to totally implode. And everyone knows that. And everybody knows that the Fed's DNA is built on avoiding the next Great Depression. So they will print until their fingers bleed to avoid that happening. And the only question is it going to be more QE? Is it going to be crazy, massive fiscal stimulus? No one's quite sure. I think that the 50 basis point rate cut they did is just the first move. And as the markets keep going lower, the policy response will get bigger and bigger. And at some point, we're going to see gold break out of this range and shooting higher. And once all the margin call selling is done on the gold shares, they'll follow along.
So Dan, you mentioned there's a few important points in that statement you made. So firstly, gold is up, last check, 8% year to date. So it's still doing extremely well versus other asset classes. Right. Do you think that people just continue to expect too much from gold?
Yeah, so QE in the last few rounds was bad for gold, and the reason is because QE is not really money printing. We call it that because it's fun and provocative, but really what the Fed does is they add reserves to the banking system, and the banking system takes those reserves, they lever it up, and they lend principally to industrial projects. So people who build airplanes and ships and buildings and that kind of thing. That creates demand for industrial commodities and also labor. And so you get a nice sugar high in prices, and employment goes up. It's all wonderful. And then typically what you see is overcapacity starts to bite, and then cash flows start to go down, and these projects start to default. What does the Fed do? They run out, they print more money, the interest rates go lower, and they reinvigorate them. The problem is this time around for them is that what's driving this shortage of cash flow is not overcapacity. That is there, and that is not a good thing for cash flow. But what's really driving it is the collapse of supply chains. Every product starts with commodities and then goes through a series of intermediate producers that produce little component parts, and they assemble them, and then more components they get assembled. Finally, you get your final project, your final product. If you're missing one component, you can't make your product. A car engine has 2,000 moving pieces in it. If one of them is missing, you can't make the engine and you can't make the car. And so you just stop producing. And it doesn't matter how much credit they offer you and in what terms the credit is if you can't produce the car. And that's what's happening all over the world and all over supply chains, starting in China. And of course, the Wuhan flu virus is proliferating here in the U.S. too. So things here will slow down. And there's nothing the Fed can do to help that through QE. What they can do is say, okay, you owe money to the bank, you can't pay it, we'll just print it up for you, you can pay it that way. That's not adding net credit and jobs and frenetic activity. That's just simply covering current expenses. And think about the fact that the U.S. is already running $1 trillion a year deficit in an expansion. Now, all of a sudden, we have a major contraction in economic activity, and the White House is talking about, and Democrats, about huge fiscal stimulus, and there's only one place that can come from, and that's the Fed printing money. And that money, again, is not the credit kind of QE that's bad for gold, because gold hates credit growth, it likes credit contraction. It's straight money printing a la the 70s or so other analogies, and that's fantastic for gold prices.
So, Dan, in the past, I want to pick your brain on that thought, because you spoke about the path to $3,000 gold, and you said it depends really on the Fed's next move. As we know, they cut 50 basis points. There's talk they're going to cut again. But how much room do they have left? And are you sticking to 3,000 as the next forecast for gold, or do you see it being higher now given the context?
Yeah, well, so I've written papers about the fact that if you actually expect gold to balance the Fed's balance sheet, which I do, that's gold's function eventually, is to balance balance sheets. Gold has to get up to the number, $10,000 around that level, where the gold and the Fed reserves and the Treasury combine the balance sheets, balance their liabilities. So that's where gold's heading eventually when the whole system liquidates. I don't expect that quite yet or anytime soon, but obviously to get to 10,000, you got to hit 3,000 first. And I think what gets us there is going to be the huge Fed response. Again, lowering interest rates isn't going to help in this case. What you got to do is literally print them with a helicopter drop of money that the Keynesians have been talking about and Milton Friedman talked about for decades. This is the last tool in their toolkit, is you rev the helicopter up and you sprinkle money on people, whether it's sending them checks or a payroll tax cut, or huge spending by the federal government, or forgiveness of loan payments, which they're doing in Italy. Or they're saying no one has to pay their mortgage payments because no one can, because no one has jobs. Well, where does that money come from? They print it. So that money printing, again, is not credit conducive. It's simply paying your current expenditures, and that is a straight debasement. There's a huge difference between credit inflation and currency debasement, and we're moving from the credit inflation, which is bad for gold, to currency debasement, which is fantastic for gold. So I think once these trends establish themselves, clear, gold is going to go a lot higher.
So higher than your original call of 3,000, or are you sticking to 3,000?
Well, as I said, it's got to get there first. But I mean, when the whole system liquidates, which is going to happen at some point, then gold has to be up in the $10,000 level. Is this the event that causes a total liquidation of the system? I mean, that's a hard call, but that's where we're heading eventually. And that assumes, by the way, that the Fed's balance sheet doesn't change significantly. Of course, it's going to, as they're going to buy everything. Janet Yellen recently, I recommended the Fed should start buying, I think she said stocks, which European central banks do, and they buy corporate bonds. Our Fed cannot do that yet under legislation, but give a crisis big enough, and Congress will act immediately to allow the Fed to do that. And as they worsen their balance sheet, the ultimate price objective for gold, when the system finally liquidates, goes that much higher. Okay,
let me ask you this. Physical or mining stocks, where would you be right now?
Well, in the very short term, I think bullion's a better bet, because bullion responds immediately to these monetary trends, and with mining stocks, you have the cross currents of what's happening to other investors. I mean, you own Tesla in a gold stock. Well, Tesla gets crushed. You get a marginal. You got to sell your gold stock too. But there's no question in my mind at all that as gold goes higher and as the input costs go lower, I mean, the oil is collapsing, which is fantastic for gold mines. And then also the inputs for gold mining compete with base metal miners, so copper miners, zinc miners, those sorts of things. And as especially China blows up, and don't forget, China buys about a half of base commodities in the world. As that goes away, all those mines will shut down, and they'll release resources into the gold sector, and those prices will collapse as well. So I think over the medium and long term, gold miners are a much better bet here.
Now, I know you deal mostly with the juniors, but are you better off buying the majors that are so leveraged to the gold price? I mean, we see how well Newmont's doing, Kinross, Barrick, obviously.
Yeah, absolutely. Look, the big producers, the market figures out immediately these trends, and again, once the market liquidation stops, you can value the cash flow, and it doesn't take any time at all. The juniors, it takes longer for the capital to reach down there because you need either third-party investors to come and invest in their projects, or you need majors to buy them, or you need aggressive intermediate companies to roll them up. All that will happen, but it takes longer for that to happen. On the other hand, the juniors are so depressed because they've been frozen out of the market for so long that I think the ultimate gains in juniors will far surpass those of the majors, but it will take a little longer for that to happen.
Finally, Dan, are we going to see more mergers and acquisitions in the mining space if the gold price keeps rallying higher?
I think so. Yes. I mean, as you know, one of the barriers to that is our management teams who don't want to merge because then they're out of a job. But the prospect for capital raising in the juniors has not been very bright recently, and I think that there's so much advantage to some of these companies from amalgamating that the shareholders will just simply make it happen. And even if they don't, what will happen is, as I said, the majors, intermediates will start snapping them up. And that's already starting to happen in some of the smaller names that I follow. So as gold goes higher and the producers start just producing tremendous amounts of cash flow. Remember, in mining, your profit reflects your capital costs in some part. So in some ways, it reflects the mistakes of the past. What you really care about is your cash flow. And as these mining companies start having tremendous cash flows, as their costs go down, their revenues go up, they're going to want to deploy it back into the sector. And it's much easier, as you know, to buy an explorer, buy a developer than it is to start a brand new project that takes 10 or 20 years to develop. So yeah, at some point there'll be a competing feeding frenzy among the producers to go buy the best assets and then eventually the worst assets of the gold sector.
Dan Oliver, thank you so much for joining us today. Good thoughts from you. Thank you.
Thanks for having me.
And thanks for watching. We will have much more for you, so be sure to stay tuned to Kitco.com.